USDC circulating supply drops by $1 in 7 days. Cointelegraph reported on May 16, 2026 that the circulating supply of USDC has fallen by roughly $1 billion over the past 7 days. The contraction comes during a soft week for crypto majors, with Bitcoin at 78,158, down 1.6% on the day, down 3.3% over 7 days, and Ether at 2,178, down 2.4% on the day, down 6.5% over 7 days. As of May 16, 2026, the CoinMarketCap Fear and Greed Index sat at 43 in neutral territory. A net redemption of that size is the kind of weekly print that stablecoin desks pay attention to. Circle issues and burns USDC against fiat reserves on a one-to-one basis, so a decline in circulation generally reflects holders moving from on-chain dollars back into bank balances rather than rotating into another stablecoin or risk asset. The redemption mechanic and what it usually signals USDC supply expands when authorized participants mint new tokens against deposited dollars and contracts when they burn tokens to redeem dollars. A weekly delta of about $1 billion is meaningful relative to the steady drip of mint and burn activity in a flat market, but it is not a record. Circle has absorbed larger weekly swings during stress periods, and routine treasury operations from market makers can drive multi-hundred-million-dollar moves in either direction without any underlying market signal. The interpretation that matters is directional. When stablecoin supply grows, traders read it as fresh dry powder waiting to deploy into spot. When it shrinks, the reverse logic applies. Capital is leaving on-chain and either parking in money market funds or sitting in bank accounts. That framing fits the current tape, where Bitcoin spot ETFs have seen heavy outflows and altcoins are underperforming. Pairing with the broader market reaction, the contraction does not happen in isolation. BTC trading near $78,000 represents a multi-week drawdown from recent highs, and ETH at $2,178 is closer to the lower end of its 2026 range than the upper end. SOL is at 86.71, down 3.5% on the day, and the 7-day prints across majors are uniformly negative. Stablecoin supply moving down alongside spot prices moving down is the textbook risk-off pattern. The cleaner read would be if USDT, the larger stablecoin by float, shows a similar move. If Tether's supply held flat or expanded while USDC contracted, that would point to specific Circle-related flow, perhaps US institutional redemptions during the inflation-driven ETF outflow week, rather than a market-wide stablecoin retreat. Reading this against the current macro backdrop, US spot Bitcoin ETFs have already absorbed roughly $1 billion in net outflows over the past week, as inflation prints reshaped rate cut expectations. A USDC contraction of similar magnitude is consistent with that exit door. Dollars leaving the spot ETF complex and dollars leaving the on-chain stablecoin float are not the same flow, but they often correlate when the underlying driver is US-based institutional positioning. The fear and greed reading of 43 is the giveaway. The market is not panicking. It is not euphoric. It is cooling. And the supply-side data on stablecoins is consistent with that. Implications for users holding stablecoin balances. For stablecoin spending and savings decisions, the headline number matters less than the trend. A single week of net redemptions does not change the credit quality of USDC or its peg behavior. Reserves remain backed by US Treasury bills and cash equivalents, audited monthly. Holders of USDC on cards that draw from a USDC balance for spending should see no operational impact. What it does signal is the broader environment. Stablecoin float expansion has historically preceded constructive periods for risk assets, and contraction has preceded or accompanied corrective ones. This week's data fits the latter pattern. The next week of supply prints will tell whether this is a one-week redemption tied to a specific outflow event or the start of a sustained float reduction.